Over the last 30 years, as globalization has accelerated, the gap between rich and poor countries actually began to shrink for perhaps the first time in modern history. Hundreds of millions of people, especially in places like China and India, have been lifted into the global middle class. By that measure, global trade has been a powerful force for equality. But in that exact same period, the gap between rich and poor within many countries, including the United States, has grown dramatically. So, how can trade be a force for equality on a global scale, but a driver of inequality at home? This paradox is at the heart of the political economy of trade. And in this video, we're going to bring together everything we've learned about trade balances, exchange rates, and protectionism to ask a bigger question: who wins and who loses, and why? How do the rules of the global economy create these outcomes? Trade is often presented as a win-win, and in theory it can be. If countries specialize in what they're relatively good at and trade for the rest, as comparative advantage suggests, everyone should gain. Global output increases, prices go down, and markets grow. And in many ways, that story is true, but theory isn't policy. And the benefits of trade aren't evenly distributed. That's where political economy comes in. In practice, every trading relationship creates winners and losers, both within countries and between them. Within countries, some industries expand because they can export more or source cheaper inputs. Others shrink because they can't compete with foreign imports. In the United States, for example, tech and finance have gained from globalization, while manufacturing communities, especially in the Midwest and the South, have seen factories close and jobs disappear. This reveals a classic dynamic in political economy. Even if trade raises the overall national income, the costs are often concentrated, felt intensely by working class communities, older workers, or those without the flexibility to retrain or relocate. Meanwhile, the gains from trade are often diffuse, spread thinly across millions of consumers who may barely notice that their cost of their goods is a few cents cheaper, or across investors who see rising returns. This imbalance, where the pain is sharp and localized, but the benefits are broad and maybe even invisible, helps explain why trade is such a politically charged issue. And inequality between countries can also increase. Some countries, like China, South Korea, or Vietnam, have successfully used trade to fuel rapid development. For example, since joining the World Trade Organization in 2001, China's per capita GDP has skyrocketed from around $1,000 to over $12,000, a historic economic transformation. But others, especially in parts of sub-Saharan Africa or Latin America, remain trapped in low-value production, exporting raw materials and importing finished goods. Many of these countries have seen far more modest growth, struggling with volatile commodity prices and trade rules that often favor wealthier nations. Their terms of trade are shaped by structural disadvantages, including poor infrastructure, limited bargaining power, volatile currencies, or trade rules that favor wealthier nations. And even in countries that grow rapidly like China, rising inequality and regional disparities may still present real challenges. Trade, in other words, creates winners and losers, not just economically, but politically. The winners grow in influence and power. They shape trade policy, they lobby for new rules or protections, and the losers often get left behind. So we know that trade creates winners and losers, but how exactly? Let's connect this to the specific tools we've already discussed. As we've already learned, a strong currency makes imports cheaper and exports more expensive. So who wins with a stronger currency? Consumers who can buy cheaper foreign goods and companies that rely on imported parts. This benefits service-based economies and global retailers. And who loses? Domestic manufacturers and their workers who find it hard to compete with cheap imports and to sell their products abroad. A strong dollar, in other words, can be great for shoppers at Walmart, but devastating for factory workers in Ohio. Tariffs and subsidies, as we saw with the U.S. sugar industry, are prime examples of how policy creates specific outcomes. Who wins? The protected industry. A relatively small number of sugar producers and their employees receive significant financial benefits from artificially high prices. Who loses? Every single consumer of the product containing sugar, all of whom pay a higher price. The gains for the industry are concentrated and politically powerful, while the costs for consumers are spread so thin they're barely noticed, a classic problem in political economy. A trade deficit, as we've previously considered, must be balanced by capital account surpluses. This has its own set of winners and losers. Who wins? The U.S. government, which can finance its debt by selling bonds to foreign investors. Tech startups and other businesses who benefit from the influx of foreign capital looking for a return. And who loses? Again, workers in import competing sectors. The same capital inflows that fund a tech boom in California might be linked to the trade deficit that hollowed out manufacturing in the Rust Belt. These tools aren't neutral. Each one creates a specific set of incentives and outcomes, directing the benefits of trade towards certain groups and the cost towards others. So, if trade creates winners and losers, the next question is, who decides the rules? Who gets to shape the global economy and whose interests are protected or ignored? This is where we shift from economics to political economy, the struggle of how power, institutions, and policy choices shape economic outcomes. Trade doesn't happen in a vacuum. It happens in a world shaped by governments, interest groups, corporations, multilateral institutions, and structural inequalities between rich and poor states. For example, trade rules like tariffs, intellectual property protections, or labor standards are often negotiated by wealthier countries with more leverage. Institutions like the World Trade Organization or the IMF set standards that can profoundly affect domestic industries, especially in the global south. And even within countries, trade policy often reflects the influence of the groups who benefit the most: multinational corporations, export-oriented sectors, or industries with strong lobbies. And while an economist might ask, does free trade increase efficiency? A political economist asks, efficient for whom and who decides? This shift in focus is critical. Trade policy is not just about maximizing GDP, it's about prioritizing interests, managing risks, and navigating power relationships, both domestic and local. That's why countries protect some industries while exposing others to competition. It's why trade deficits can become political flashpoints, and it's why trade isn't just economic, it's deeply political. Let's return to the paradox we started the video with. Over the past few decades, global trade has lifted hundreds of millions of people out of poverty, especially in countries like China and India. By that measure, trade has been a powerful engine for global equality. But at the same time, inequality has widened within many of those countries, including the United States, as the benefits of trade have flowed unevenly across sectors, regions, and social groups. This may seem like a contradiction, but it's actually a reflection of how global trade really works. Trade is not a neutral force. It's a system structured by policy choices, power dynamics, and institutions that shape who gets what. We've seen how exchange rates affect competitiveness, how trade balances reflect the flow of goods and capital, how protectionist tools are used to defend or distort economic priorities, and how every trade deal creates winners and losers. Understanding trade as a political economy means more than asking, is this efficient? It means asking who benefits, who pays, and who decides the rules. Because in the end, trade isn't neutral. It isn't just about prices and products. It's about power, policy, and the kind of world we want to build.